Welcome back. You're watching Indian Open. Well, joining us now in our studio is a very special guest, Sanjay Nayar, the CEO of KKR India, one of the biggest private equity firms in the world, and of course a big investor in India, $8 billion, I think, since it came to India. Diversified interest areas, including real estate, infrastructure, BFSI, technology, and pharmaceuticals, which we must talk about today. Sanjay, welcome to Bloomberg Quint. Lovely to have you on set this morning. So this is what we want to hear from you. What your outlook on the economy is, given that there are so many conflicting voices. What your outlook on the investment cycle is, given that there are so many conflicting voices. What the government should do to fix the problems, if you think there are problems. What you think of the private equity environment in India. How difficult was it to get in and out of Fosun, Gland Pharma, sorry, not Fosun. Do you believe that the environment is conducive for investments here on? And now that I've asked all the questions
Let's
up front.
step off.
Yes, I know.
Let's just go.
We're just going to hand it over to Sanjay. Now it's over to you.
Break it up for me in parts and pieces. Yeah.
Okay, no, but genuinely, I think there are just way too many conflicting voices on the economy. You look at things grounds up, right?
Yeah.
All the entrepreneurs you meet, all the businesses you invest in. What do you think?
Okay, look, I think, as I was telling you earlier, I have felt for many years, I mean, not to do with this government or which government, but since the time I was at the banking system itself in 2002, I think from 2004, I've always said that India is going to be stuck in this growth rate of 5-6% because we just somehow, government after government, we don't tackle structural reforms. So I think where we are today is frankly no better than where we were in the past. Probably an opportunity lost because we, for the last 3-4 years, had pretty fantastic tailwinds, right? Commodity prices, oil prices. I think we did inherit a lot of problems. And by we, I mean I'm talking of this tenure, I'm sure, because that's where your question is going to go. We did inherit a lot of issues as it relates to bad assets in the banking system, which is definitely a making of at least past 7-8 years of bad projects, bad project financing. So I think that you'll always be stuck in this range unless you make structural changes. So we are unfortunately settling down at a kind of a low common multiple. And so this is one part of it. The other part is that this government actually has done some really good stuff. If you look at the conviction, the honesty to do things, the urgency to do it, the work ethics are great. And I think as a part of formalizing the economy, or let's say institutionalizing it, demonetization, GST are all very, very well-meaning reforms. I mean, I'm not going to comment whether it was political or not, but I think they're absolutely music to the ears of foreign investors who are long-term investors like us. So if you have a much more institutionalized economy, that is something we love to have. So I think steps of this nature help. Now, were they well-timed? Were they well-executed? I think those are question marks. So I think where you're today is you've got urban consumption picking up a little bit, rural consumption down, investment demand down, consumption on the whole balanced off between urban going up and rural coming down. And I think you stay like this and you are unfortunately prone to cyclical growth numbers and cyclical issues. And because you're supply constrained as an economy anyway for God knows how many decades, each time consumption picks up, you have a spike in inflation and then you have a hawkish central bank. So you really have to therefore tackle structural issues to get to the next level of growth and break out of this. So either you can now be India can be a picture of great economic stability at a low level of growth, or you want to break out of this 6.5% mode and get to the 8.5, 9, 10. And that you just cannot wish will happen, frankly. I think you've got to do things to get it done. So I think India's got a fantastic opportunity. As I said, you've got a government that's extremely well-meaning, extremely hardworking, wants to get things done. But I think you've now got to get beyond that and say, okay, what are the 3 things we need to do?
Okay, what are those 3 things, Sanjay? Let's be straight up about this thing. What are they missing?
I think what everybody is missing, frankly, in the country for many years is you've got to tackle the fisc. I mean, you've got to tackle the size of the fiscal deficit. We keep playing with numbers. People keep commentating on, 3.5, 3.7, 3.2. The fact of the matter is that the Indian government is a dissaver, and you've had a fiscal deficit for 2 decades, and it preempts all the savings of the economy. Let's face it, today we borrow 95% of our fisc from Indian savers. So The government is a dissaver. It borrows from the private savings, so there's nothing left for the real sector. So that is the crux of the issue, right? And that's why we can debate real rates are high or low, equity markets are overvalued, undervalued. But the fact of the matter is, your entire risk-free rate itself is corrupted by the fact that you have a huge borrower in the market. So I think the biggest structural reform one has to think of, and again, timing is very tricky now. It's very complicated, right? You need to stimulate growth.
Yeah, I was just going to say
so you just can't now go cut the fisc, and I think that's really the kind of a tough situation. But each time we have comfortable situations like easy commodity prices, good tax collections, we should have done this. So I think tackling the fiscal in a structural way. So what are those things, right? That's the key issue here. I think you've got to have measures to unlock, negative public sectors. I mean, you just have to divest and make serious divestments, okay? Not, one or two things here and there. And I think you've got to get the investment spending and the growth back on track, which is a whole separate discussion I'm sure we'll have, so that revenue collections go up genuinely. I think tax administration and plugging tax holes, a lot has already happened, so I'm sure that will help a little bit. But unless the number of tax filers go up and there is a general formalizing of the economy, I think.
Well, this government would argue that they've been slowly doing.
They've been doing
investment.
it. Yeah, no, they've been doing it. Look,
they've been doing. GST is a step towards both formalizing.
That's what I'm saying. You're formalizing
it.
It will take some time. So I think just for the measures they have taken, you have to give it another 6 months or 2 quarters to see the impact of that coming through. But what I'm saying is, I think it will work out for March numbers or maybe next June numbers, but you're not going to break out into a new growth rate. That's what I'm saying. I'm saying you're going to keep, moving between this 5 and 6.5 all the time, unless you make structural changes. So I think the second big structural change is you have to do something with the banks. I mean, either you can create the bad bank and take just the bad assets off. I mean, China is doing its third bad asset management company, the third already. So you tackle that head on. I think you've got tough structural reforms. I can't even recommend them. Are land and labor, which was tried and not easy to get done, but those are real issues that really improve the productivity of the economy, okay? And finally, back to my first point, once you can tackle the fisc structurally, then you have real capital markets that really intermediate savings to investment opportunities. I think those are 3 big things. Yeah. You got to have, a structural change in the fisc. You got to tackle the bank problem, and you got to do some tough reforms as they pertain to.
Before I pass it on to Neeraj and Neera, I just want to know, how many years have you been saying this for?
When I came back, I remember to head Citibank in 2002. I've been saying this since 04, 05, and we've had a structural problem on the fisc. I think that actually the complexion of spending of the fisc has improved a lot more under this government. I mean, you've got to face it. MSP is not a giveaway. I've cut down on not giving unnecessary subsidies. So the complexion of spending has changed, but I'm not worried about that. What I'm saying is you just got to tackle the fiscal problem, and you've got to get out of the way of private savings. Today they preempt 95%, they as in governments at large. That's the starting of the issue.
Sanjay, I'm just going to pick up on the bank story, slightly more immediate. So, we didn't go with the bad bank. We went with this IBC and, the RBI dramatically coming in and starting to dictate which accounts go or not. Any indication of whether that's working better than the bad bank would have worked? So I know that there are a lot of ARCs, and I know you have an application for an ARC as well. But I remember at a Bloomberg forum, you had said that we are nowhere close to clearing price. What we hear is that it's still the same. So even if you go into IBC, who's going to pick up some of these assets?
No, look, this is a short answer. We as a firm, and I know a lot of our other peers also, are ready with real funds, long-term funds that can come into buying bad assets and actually repairing them and making them better, because there are many assets which are repairable. Today, a lot of assets are going down under because working capital is being squeezed, banks are not lending. So a poor guy who needs 180-day capital but gets only for 120 days, he begins to become a bad asset slowly, and then you start evergreening these things. So your real problem becomes bigger than actually it is. So there are enough assets available out there which we can buy, repair, create value, not only for ourselves but for the bank, and God forbid, maybe even for the promoter if he's got a tail left in it. So, but that time is going very rapidly away because you did not get the assets out in the right time. So a chemical plant that is shut can't be shut for too long yet. I mean, if it's shut for like 3 years, it's pretty much over. So I think that's a big issue. We have talked about fair market price for a long time, but the banks haven't managed to hit that bid because they find that it's below replacement value. Some people find it's below their reserves, whatever the reasons be. And I think we're coming to a point where this problem compounds every quarter. So ultimately, if you're going to do orderly liquidation, then we have no role to play because we're not liquidators, okay? There are enough ways to do liquidation of assets, and that's, I think, unfortunately, where this whole thing might head.
Really? You think that...
No. Well, lots of things, ultimately, if you can't recover them, either you'll buy them at the pennies. So let's say we were offering 50 cents of the dollar, it's probably worth 30. By the time the IBC process happens, it's probably worth 20. And there's no bidders for it, it's probably worth 6, which is what happened last time. So it's, okay, the process will be cleaner, people will feel more secure about it, but you've taken a massive hit here, and you've lost productive assets. So I think you've got to be more dramatic, and that's why a bad AMC or a bad bank is the way to go. You know, and then you use all the fiscal benefit you have and just capitalize the banks. Of course, the best thing is to privatize these banks, but let's not even go that way. Because last time we talked about this, it wasn't, I mean, it's not understood why would you privatize a PSU bank. The question is, why do we own banks? I mean, at the end of the day, right? So that's a different issue.
And that's an issue we could debate for a very, very long time and
I have one specific question, sorry, on this, this working capital issue. So I believe a lot of money is being taken from these special situation funds, and I think, you have some lending in that space as well. Are more and more companies coming there because banks are not being able to provide some of this working capital finance?
We have a big NBFC and we have a big special sits fund, but we don't go around helping companies that are NPLs. That we'll do only through our proper distressed approach. What we are doing is we are plugging the last mile in many cases, and we are plugging extended working capital requirements which the banks are not fulfilling today. So our NBFC is extremely busy because the amount of demand we are getting from well-performing companies who are, because of GST, because of supply chain bottlenecks, because of exports, you've got working capital extension. So we are helping a lot of those. And I think that's a very valuable contribution that NBFCs in general are doing today. We are just one of them, but there are many
rates are really high, no? I mean,
they have to be higher than the bank rates, right? But the fact is we are providing extremely important capital.
Right.
And just one more point I want to make, that if you and unless we're going to talk about foreign investments maybe later on, but I think what you need really is long-term capital, and I think these NBFCs are providing that, just the way PEs are providing long-term capital, unlike the market moves. So we'll come to that later.
But did your ARC license come through?
No,
because
we are waiting.
Now when we are seeing large assets there, right? SR Steel's in the insolvency process. Who knows? Reliance Communications might go into the insolvency process. These are large, several tens of thousands of crores worth of assets. I'm guessing you'd be interested.
We applied for the ARC after the finance minister announced that there was going to be 100% ownership allowed for private equity. So we applied for one because we are serious players in India. We're not here for the short term. But I think our application is still under approval at the Reserve Bank.
How long has it been?
I think we filed pretty much after the last budget statement. So I would say if it's not a year, but maybe just about getting there. I think that it's probably a new kind of an approval for the RBI, right? I mean, ARC is being owned by private equity. And I think that's why it's taking time. So we are pretty patient. It's another part of our toolkit, right? So the way I look at this is, we want to have a toolkit in India that covers mezzanine credit, real estate credit, long-term private equity, and an ARC, so that we can really be a provider of solutions. So that's really the whole agenda. So if it takes another 6 months, so be it.
Right.
It's not the end of the world, and it's not like we can't bid for assets anyway. We can. Yeah.
Okay. I have a couple of questions really on two pockets which are of the market's interest as well. Firstly, real estate. You have exposure out there too. I'm sure you have a lot of opinion. Conversations seem to suggest that the pocket which will probably do well over the course of the next or the foreseeable future is low-cost housing or housing in that bucket, not really the sector as a whole. Is that a reasonable estimate?
Look, we're not big real estate private equity guys, frankly. We are more real estate lendings. We do a lot more lending.
Sure,
and we have found again that with the RERA coming in, with again this whole GST and demonetization, I think that sector we are getting more comfortable with, frankly. Yeah, because it was always a part of the informal economy and is becoming much more formal.
Yes.
So back to the point I mentioned earlier, these steps of GST and demonetization will formalize. And one sector we think which will actually benefit is real estate, where developers actually just can't take money, take sales money and skim the profit first and go buy the next piece of land. They have to deliver on that piece of land first.
Right.
What about the
So-
intermediate pain?
That's okay. I mean, look, at the end of the day, when you're sitting on land which they've bought pretty cheap, today actually we have upped our lending in the real estate sector, not reduced it.
You have.
We have, because they need more working capital because RERA has now made them in a
The
way.
escrows that were required. Yeah,
Exactly.
yeah,
So they
exactly.
can't. So actually, our lending has gone up in the real estate. We have done more this year already than we did the entire last year. So what I'm saying is that formalization here is helping actually.
Yeah.
Now I'm not commenting on luxury and all that stuff. Okay, I have no idea of that. We do mostly middle to low middle income to affordable.
Okay.
And our lending has gone up actually.
Right.
And I think that now for affordable, if you get the right parcels, if the state governments and center work together to get quick approvals going,
Sure.
not only will it be a force multiplier, which is one of the multipliers for GDP, but leave that aside, developers will start treating this like, manufacturing. You buy a piece of land,
Right.
you make the homes, you get your working capital from NBFC and banks, and you just sell the homes rather than hoard the units.
Yeah.
And I think that is how
But-
it's done worldwide.
Now, quick follow-up. Do you reckon that the operational metrics for real estate companies, by and large, will come off? The margins, safely put, they've traditionally enjoyed very high.
They'll come down,
margin.
yeah.
Will it come down? Is my
Absolutely.
question. It will come down.
Absolutely.
Okay. The other pocket is pharma, and not much to do with government intervention here. But if there is one pocket that is, let me rephrase. For a lot of companies, not much to do with government intervention. Is it starting to look up a bit after the years of pain that we've seen?
Neeraj, will you allow me to preempt your question? Just by one very
No,
short
no.
question. In 30 seconds, can you tell us the story of Gland Pharma?
I was not getting there, by the way.
We're not going to comment on a deal, Menka. You know that. We're not going to comment on it. Look, I think we had an incredible partner in Dr. Ravi Ben Metsa and his father. It's a very unique asset, by the way. Technologically, it is nothing extraordinary, but it is just the way that company has been built on a certain set of culture and values of quality. So what sets Gland apart from the rest is that you've got minimalistic FD observation, which makes it a very valuable asset in the trade. So look, we had a great journey for 2 years. It was a rather long process to get into it and getting out of it. But
How
besides
long did it take you to get into it and get out of it?
I mean, I would say broadly we took as much time outside the company as we took inside the company. So broadly 2 years to get
But
in
it's
and
done
get out.
now. The deal's done.
Yeah, the deal got announced on 3rd of October, and it's all closed. Yeah. So basically, I don't know if you know, but the management and the promoter is going to own 26%, and they are going to be in charge of the company for 3 years. And basically, we exited.
So, sorry, let's go back to Neeraj's question.
No, but I was
on
asking
pharma.
more. Yeah, no, well, you could have well answered that too. But do you believe that exporters, and while technology may be a different ballpoint altogether, pharma by and large, pharma exporters could actually have a turnaround after multiple years of pain? I don't know if you have a straight answer to that, but your thoughts there?
Look, I think that we're still doing a lot of conversion, frankly. We get the API from China and other markets, we convert and we sell. I think a bit like IT, we need to innovate a lot more, yeah.
You don't think it's happening?
It's not happening. Both these sectors, and that's a problem. I mean, in the long run, it's a bit like the same thing, right? You live on these cyclical numbers, you feel good about life, quarter on quarter, life goes on. But structurally, you've missed out the change and the innovation that is going on in the world. And you're seeing multiples come off.
Some data suggests that private equity investments in the first 9 months of this calendar year were somewhere above $17 billion, much better or a little better than the previous high of 17.3. So 17.6 versus 17.3. We've also on the flip side seen through a bunch of IPOs in the last several months, a lot of exits for private equity. And I think that's been a tough thing to achieve in India, the exit bit. It's finally happening thanks to where the equity markets are. Do you see a lot of this money very quickly come back into the country?
Absolutely.
So
I think on private equity, very straightforward. I think there is, just as private equity fund managers, India is now seen as a very interesting place, right? For a couple of reasons. One is the formalization of the economy we just spoke about, and general economic stability. So leave growth aside for a minute, but general economic stability, medium level growth, whatever it is. and the saving investment gap, right? So you're being presented with an opportunity here to private equity where companies need that gap to be filled if they need to grow or they need to take the previous investor out or whatever. So that's one. So massive opportunity. I mean, I think all PE firms today are flooded with proposals of the most ordinary growth kind to the most complex transformational and consolidation kind. The second thing is that, as you said, that we had not seen many exits, and ultimately investors who back us want to see money come back.
Yeah.
Even if it's 5% returns or 10%, doesn't matter. They need to see money come back, and India has never given money back for a long time. And I think for the last 4-5 years, better capital markets, I think much better clarity on tax, okay? You've got to admit to that. We're not fearful about the fact that, we're going to be questioned by the tax guy. Very clear, simple rules. They've simplified a lot of things. So net of tax, you've taken money out of the country, either through public markets or through trade sales, like we sold Alliance, our Gland. There's clear-cut process. So that's the second. And the third is that there is still there's a big opportunity of getting into these companies and actually making them better. And the Indian entrepreneurs now who are either selling or inviting private equity are finally accepting private equity as an asset class that can be helpful to them. So on improvement of operations or whatever. So if you put these three together, this is the right recipe for that. And then add on to this, dire need for deleveraging,
and all of that.
Succession planning, all the other good stuff, right?
Dramatic increase in amount.
Massive increase. And I think this is no big number. This numbers will just go up. And do not compare this to the market volatility, because where I think we all miss it is the FIs come in and go out. But the private equity guys, this is the right time where we're going to bring in more money.
I have one question, Sanjay. I mean, not private equity maybe, but when we talk about long-term foreign investors, the sovereign wealth funds, etc., is anybody dipping into core sectors? I mean, there was a time when everybody was very excited about infrastructure, etc., etc. Then it sort of died down. Now nobody knows where the projects are coming and all of that. Going to core sectors and not consumer sectors.
Yeah, so I think derivatives of core, yes, like we did cement long time ago.
Cement you did, yeah.
People are doing logistics now, which will benefit a lot because of GST and much more seamless movement of goods. So I think you will see the derivatives of core for sure. Okay. As far as core is concerned, honestly, this private equity pool of capital is not the right pool.
Yeah, that's why I said sovereign wealth funds, pension funds,
pool,
etc.
And infra funds are not yet allocating to India. And I think it will take a few years of government spending, which they're doing, success of a few projects, inviting in a few sovereigns on a one-off basis, right? Come for this project. Let somebody make 4 or 5% in dollars and go home, and then this thing will catch on.
Like the bullet train.
No, not the bullet train, but I mean generally there's a portfolio of roads, portfolio of ports, portfolio of bridges that are being made. So some of these can let the government seed them, then maybe take them off the balance sheet of the government, and then let some foreigners who have big funds come in and make 6%, but on a predictable basis, rather than what happened in the previous government was that a lot of things went backwards, which led to all these.
So imagine a giant government REIT or a giant government InvIT of some sort, infrastructure trust of some sort, right?
But there's a
where
lot
they pool all these assets together and then they bring
whether
in
you
investors.
pool or you do,
and you earn a yield, right? I mean, at the end of the day, that's all you want from infrastructure.
Absolutely, and you'll be amazed at the amount of money that's available in the world to come to this part of the world.
But it isn't coming here. We've had the, the NIIFLs and IFF.
No, the NIIF.
NIIF.
Yeah.
And all exporting money, sovereign money, wealth money for so long, and none of
about one deal, I think.
No, but you got to demonstrate that you've done the assets, matured, and that you have a constant policy, say, on tolling. And I think the government is right now still building that portfolio because they're spending a lot on their own. And after that, they should invite the foreigners, including Indian savings, because by then, if you get the fisc down and Indians can buy a same thing at 6% inflation adjusted,
and
I would definitely put my money.
So it has to be a yield thing. Unfortunately for us, infrastructure has so far been an equity thing, right? We can't, and then that's not the best risk profile to have.
And therefore, the government seeding it in the middle and incubating is a pretty good idea.
Yeah. Neeraj?
No, just a small detour, Sanjay. Just hang on for a second because there's a new listing just happened. Just need to mark that because it's a healthy listing that's happened. And then I have a follow-up question on the supply of equity paper in the Indian markets as well. If you can maybe give a comment there. But 37%. For Pratap Snacks as it lists and heavily subscribed. Good to see that the listing is pretty healthy as
Did
well.
you say
200
healthy?
times
Potato chips.
No, but it's 200 times FY17 earnings or something, right? This is the stock that was listed.
No.
Yeah.
No, this
Of
is not-
course.
No,
of
this
course.
is still cheaper. No. This is not 200 times. This is still cheaper than DFM Foods, which is its competitor. So Pratap Snacks is okay. But yeah, 100 times subscription on the HNI category. So there is a century out there of some sorts for Pratap Snacks. But good going there. 1286. In moments from now, we'll also hear the management. But Sanjay, just a quick thought here. The quantum of supply coming in, I mean, insurance is large, overvalued, therefore not buying takers. But a lot of other quality papers, so to say, coming in. Important, you reckon, because the amount of money being pumped in by domestic investors into the market is not small either.
Look, I mean, it's quite amazing how all of us in India have reset our expectations so low. Having 6 IPOs in a month is not a big deal, okay? Just to be clear. There are 20 IPOs in the US every day. So, I think this is a good sign. Having more IPOs, more quality paper, nothing wrong with it. I think we need to see a diversification of the buyers also, right? And I think that will again happen as you get out of the way and let savings come in. But I think some of these earnings are just, these multiples are quite crazy. I mean, things will calm down because this is just complete madness.
You look at the markets as overvalued at this point in time, making it tough for you to find new investments.
We don't invest in public markets, but just taking a step back and thinking of a market trading at 20 plus.
But you're invested in several listed companies, aren't you?
No, but those became listed. We don't invest in them. They became listed.
But you invest in them even after. Like, for instance, Bharti Infratel, when you did the second tranche, it was listed. Dalmia, was it listed after you invested?
Yeah, it was unlisted.
Oh, okay. Sorry.
So, no, I think that these kind of earnings, these kind of multiples look high today. If you were to just take a step back and what we spoke about since the beginning, if what real growth rates are what they are, there's still a degree of underutilization of the capacities. I can tell you that there isn't much pricing power, okay, for a lot of these companies. So I don't see where you get growth, earnings growth. So unless you see real earnings growth after the next few quarters, the markets are clearly overvalued. At least from my point of view. Next few quarters at least.
You had some other controversy come your way. Cafe Coffee Day ran into some trouble a few weeks ago.
Yeah, but that's specific to the promoter. I mean, nothing to do with us, yeah. We just listed company.
Max Financial Services?
Max Financial, we invested about a year ago.
2016.
It's doing pretty well. It's a great company, good quality. But again, we don't want to comment on any of the companies. So.
The deal, okay, fine. But I just want to know the deal that was in the making for Max with HDFC Life and all of that.
You know the press, and you follow the press like I do.
So you're disappointed that it didn't work out?
Not going to comment.
Okay.
But it's doing really well on its own.
Okay, all right. So then let me ask you a most generic question, which is my last question really. What looks interesting right now? I mean, you've studiedly stayed away from e-commerce and all of that. I think some of the big deals this year that have happened in that space or in the shared services space and things like that. You've stuck to more traditional economy companies, consumer-facing companies.
I think for us, I think our focus is to spend a lot of time now with the conglomerates and big companies and see where we can help them sell things outright or significant majorities, right? Because I think we've done enough of this growth investing stuff, and growth is a bit elusive right now, or at least, for at least the value you've got to pay for it. So we have to create situations, and I think where we're spending our time is to look at conglomerates and companies who are looking at deleveraging and deconsolidation.
So pure buyouts?
Pure buyouts, significant majorities, very significant minorities, but very significant majority is the way we want to look at. I think we can be impactful there, we can be value added, and these hopefully will be more transformative deals which will improve the return on capital and for the larger conglomerates. A lot of people today have just a lot of companies developed over time, and I think they're looking for serious deleveraging opportunities. So that's what we are focusing on. And there are many sectors.
If you see an SR Steel in insolvency, a Reliance Communications in insolvency, Sanjay, do you feel that if you had a license at this point in time, you might actually be interested in being part of their resolution plan?
But by the way, ARC license doesn't come in the way for us bidding anyway. So just to be clear, so some sectors we wouldn't look at if we don't like the industry. But some others, if there is a problem at a group level, okay, if there is one company we like, we could actually, that's exactly the focus. Look at one part of a group and see if one can put significant capital there, get ownership, and that way deleverage the top. That's exactly what is the kind of stuff we want to focus on. And there have been so many of these in the press recently, right? You've seen it in the telecom sector, you've seen in the healthcare sector, now you're seeing it in again, telecom-related sectors. So private equity can play a very significant role in giving that capital.
Okay.
But if we believe we can improve the asset and we can create more value, only then. Otherwise,
got it.
It's different.
Yeah.
Okay. We're going to thank you for joining us on set this morning. Thank you so much, Sanjay Nayar, for talking us through the economy and the investment climate. And with that, we're going to have to wrap it up here on Indian Open.